I'm Shane Bangle with the Manna Group, and today I want to spend a little bit of time talking about what the federal funding rate is, what the Fed interest rate is, and how that relates to mortgage. We pride ourselves in the Manna Group of being educated and knowledgeable and helping you understand the market, where things are at. So one of the most important things, and one of the, I'd say the main driving force in buying and selling right now, has been mortgage interest rates. We study these things, we pay attention to it. Obviously, we have some great lending partners here locally that are the experts that we go to. And certain situations obviously get more complicated than others, so we really try to then say, hey, listen, please go talk to this person. They're going to give you great advice. They're going to help you. They're going to guide you. But we make sure we know it on an expert level. So recently you may have seen a bunch of people posting that the Fed cut the funding rate. They cut interest rates by 50 basis points or 0.5%, taking the cost of capital, taking it down. A lot of realtors posted it and say, hey, interest rates are dropping, reach out. We tend to say, we're not going to market in that direct kind of way. We want you to be educated. We want you to know. Lots of people were expecting the Fed to cut the rate. And mortgage rates, mortgage-backed indexes are not directly tied to the federal funding rate. They're more closely tied to the 10-year bond, but we won't get into that. So what was happening was the market kind of knew and expected the Fed to do an interest cut. So mortgage-backed indexes started to reduce weeks leading up to, well, really like 2 to 3 weeks leading up to the Fed announcement in September that the rate had come down. That rate, when it comes down, it just means how much companies can go and borrow money for the cost of capital. They can go to the government and say, we need to borrow X amount of money, and then they go and lend that money out. Some of that money is directly tied to mortgages, but they're usually 1 or 2 levels removed. So we saw interest rates coming down. We were at around 7%, and with everybody expecting the Fed to do a cut, you saw the rate coming down. We saw 6.75, 6.5, 6.25, and we got all the way. There were some people where you could find below 6% for maybe just a point in origination costs, so not exorbitantly expensive to get a lower rate. And then the Fed meeting happened, cut a 0.5 percentage, and actually mortgage rates ticked up slightly, either anywhere from 1/8 of a point to all the way up to 1/4 of a point. And that was just a reverb to they were going down. So when the Fed cuts the rate, we don't immediately see a cut in rate. Where we'll start to see rates drop some more is if the Fed stays on this schedule of reducing the interest rate. So the Fed has to play this very fine line, right? We had too much money chasing too little goods. So the cost of goods started to go up, and that's what we call inflation. And we want a healthy level of inflation. The Fed likes to see around 2%, and they want to maintain that. But we don't want to see deflation. That's really bad. We also don't want inflation to come back. So the Fed is trying to feather the economy with controlling how much capital costs, the federal funding rate. So they're going to do some other cuts. There'll probably be 1 or 2 more this year, and then some more coming into 25. But if they start to sense that, we're doing a big cut, and then the economy starts to race out, and people start trying to run out and buy more, then the Fed's going to pull back, because that's going to, if we're all out buying and going crazy, that's going to drive inflation up, and they do not want to see that. It makes inflation's, it's hard, right? Groceries have become more expensive. Gas has become more expensive. It's very tough. So they don't want that to happen again. They want to keep it controlled. So hopefully if we see the promise of some more, I think we'll see mortgage rates come down slightly. We're not going to see a huge drop off the cliff. We're not going to all of a sudden get into the 4.5%. It will be a steady decline. Probably the most important thing though, if you have bought a house, I would say within the last 2 years, so you got into a rate that was 6.5 or higher, which was pretty normal, you need to start to exploring the option of do you do a refinance. And I would say, I would expect you, homeowners that bought kind of what we hope is the peak of interest rates, to do 2 to 3 refis over the next 3 to 4 years. So if that's the case, obviously you can reach out to us and we can help with that, but you want to go directly to your loan officer, speak with them, ask what their refi policy is, maybe ask several lenders, as each one have different pros and cons, and there is a lot of loan originators that are anxious to capture what they're calling the refi bubble. If you have any questions on any of this, as always, feel free to reach out to us. We'd love to talk to you about this process and how it all works. Look forward to seeing you again soon.